Hi there, welcome once again to the Dukascopy TV studio. I'm Ben Jones. The markets are full of conflicting data at the moment, so alongside me to discuss where investors should focus is Allan Maksymec. Allan, once again, thank you very much for joining us.
Thank you, Ben.
So where should investors place their focus at the moment when making investment decisions for the next few quarters?
Sure. So, as you say, there's a sea of conflicting data right now. You look at the Fed, unemployment is down, GDP is up, then they restate it. So investors are quite confused at the moment. What I can say with certainty is you should measure those things that have a high reliability and just tune out the rest. The rest is noise, basically, and it's difficult to do that, but that's what investors need to focus on. Data points are definitely becoming more recognizable as a trend versus a year ago. So that's the good news. However, there is this contradictory data out there. So I would say you have to focus on the most reliable, relevant data. And so, basically just tune out the rest.
Okay, now what measures should they focus on in particular, and why these?
So the ones that we like to focus on are really the most relevant for investors and the kinds of returns that they can expect from their investments. So these would be earnings, obviously, valuations and correlations are the two main ones. Here, we just had the Q2 earnings season finish. In the US, the earnings per share beat ratio, which is sort of the number of companies that beat the expectations in the market for the S&P, is at a 5-year high. So that's very good news. Companies are outperforming. Now, the other important thing was how these earnings were achieved. They were achieved by growing revenue rather than cutting costs. So that's another very positive sign in the economy. And then finally, in Europe, surprisingly, despite all the bad news that we've heard about Europe, the earnings actually showed the best beat ratio that they've had in 3 quarters. So even in Europe, while sales were disappointing, there is some glimmer of hope.
Okay, now what does a current snapshot of the data that you focus on tell us about the market cycle?
In terms of what we're looking at right now, the valuations in the S&P are constantly being debated, whether they are cheap, whether they are fairly priced, whether they're expensive, and it really depends on what your assumptions of the market and the economy are going forward. So if you assume a 2% inflation for the years to come, which is close to what the bond market is pricing, then equities values would be slightly expensive compared to the historical average. They'd be around 18 to 20 times. If you assume a 4% inflation rate, which is probably more likely once the Fed stops its interventions in the Treasury market, then you'd see valuations would be actually historically cheap. They'd be somewhere around 16 to 18 times earnings. So, it really depends. You can't say with, as a rule of thumb that it's expensive or it's cheap. You have to take a number of other things into account, which we do. Finally, I guess the last thing is you need to look at the height of the U.S. economic crisis. What were the correlations of the different sectors in the S&P 500? And at that time, in the height of the crisis, we had this risk-on, risk-off type of mentality, where basically everything got sold off when people were afraid, and everything got bought when people were feeling good about the economy. So the correlation of the S&P sectors were about 1. So everything moved together, and that's not normal. Right now, in a healthy economy, it's about half. It's about 0.5 correlation. So not all the sectors move together at the same time because different economic conditions and at different points favor certain sectors over others. Right now, the correlation is about 0.75. So we're somewhere halfway between 1 and 0.5. So I would say, we're about halfway back to normal. So I guess in summary, the earnings progression, the equity valuations, the asset correlations, all tell us combined that we have at least a couple more years of a bull market in equities.
Fantastic. And now, given the current stage of the market, what do you expect for the rest of 2014 and how should investors position themselves?
Right. So here, investors should stay overweight on cyclical U.S. equities, especially sectors like healthcare, technology, and even some of the financials, which have really shown robust recovery and growth again. The economy isn't what it was in 2005, but we're a long way back to where it was. Some examples of good quality companies would be Gilead, which is a biotech company, Qualcomm, Wells Fargo in financials. Those are all good companies. In the European equities, we would look for equities that are trading at bargain valuations that have diversified global revenues and a low exposure to Russia, just because there is some geopolitical tension there. These examples of these would be Volkswagen, Sanofi, or SAP. And basically, investors should just continue to buy quality companies, ones that have track records of growing earnings in cyclical sectors. And as the global economy continues to heal and sectoral correlations fall, they should be mindful of overvaluations in certain parts of the market.
Fantastic. Allan, once again, thank you very much for joining us.
Thank you.
And thank you for watching. Do make sure you keep clicking back to Dukascopy TV, as we'll be bringing you plenty more updates and exclusive interviews. Bye for now.